Good morning, Jags. This is Fahad. Today is Wednesday, February 10th. Let's get started. Okay, so two things I want to discuss this morning. The first one is really start off with Twitter first. Twitter is rocketing higher. It's now nearing $65 per share. It's up almost 10% in pre-market, despite the stock being so overbought that we discussed, with the stock actually trading near the channel high as well. We discussed all of this yesterday. We still went ahead with a view in webinar yesterday, which you can see right over here. And we suggested that we're going to see a potential earnings report that's going to surprise to the upside with very positive and constructive commentary. So we said that the fundamentals are going to trump the overbought technicals after earnings report comes out. And as a result, yesterday in webinar, we suggested buying Twitter March 65, February 17 diagonal call spread for $2.65 or less. This trade is going to double this morning with the stock trading at 65 this morning. So it's just a perfectly positioned trade because it will benefit from theta decay, from the implied volatility slippage in the front month, while the back month is going to gradually go up. And as a result, the trade should easily expand to $4 to $5 per contract, maybe even 5+, depending on where the stock goes. Now, I bring this up because yesterday in webinar, the key reason why I turned bullish on this name is because I looked at what the company is doing in terms of reinventing itself to get into subscription business. Specifically, they have done this acquisition of Review recently, which I believe is not baked into fiscal year 2022 consensus estimates, and it could potentially provide as much as $1.1 billion or 32% upside to revenues estimates in out years. Nobody on the street is building this assumption in their models yet. To stay on that topic, turns out, so last night I pulled the earnings transcript from the company, which is right over here, to see whether the CFO or the CEO had anything to say about subscription business or Review in specifically. There was not a single mention of the acquisition Review in their earnings transcript last night. And as far as subscription was concerned, 6 times it was mentioned, but there was this one specific question that was asked about the subscription, which is when can they expect subscription products to ship? And the management said, I'll just read this direct quote from Ned Segal, who's the CFO of Twitter. Thanks for the question. So nothing new to report on subscriptions today. We will continue to build out these teams and to research and also to test on Twitter. And I'm sure you will see those tests and have the opportunity to participate or observe them. But I wouldn't expect you to see these to be meaningful contributors until next year. Having said that, I just want to give a little perspective around subscriptions more broadly. Remember, 85% of our revenues today is showing ads to people on Twitter. And this is hundreds of billions of dollars of addressable market size. And that is growing because of secular shifts and because of what's going on in the economy right now. And we see so much opportunity to deliver better and better for advertisers and to gain more and more of that market with a growing audience, with better formats, with better performance of those formats. And so we love talking about subscriptions and the potential and the durability they can provide and predictability to a revenue stream. But we also maintain a big focus around the revenue product. Put it together, basically they didn't want to go into the details at all, but they are definitely working on it. This company is making it very clear. If you read further into the earnings transcript, they're making it very clear that by 2022 they're going to have a pretty sizable shift into the subscription business, which is going to basically bring in content creators, original content creators, the guys that want to sell newsletters, the guys that want to sell any kind of product on the platform itself. Just like if you have an Amazon, if you go to Amazon, you can sell a newsletter service right through Amazon. You can even create your own magazine and sell it right from Amazon Prime. This company wants to do exactly that. And I believe this is a substantial opportunity and it's going to change the revenue mix substantially in the long term. So I just wanted to point out that the bull case that I presented yesterday still stands. However, with a gap higher of this magnitude and our diagonal call spread doing so well, the best thing to do is to just take profits on the gap higher and step aside. Second thing that I want to discuss quickly is interesting company called Benefit Focus. Benefit Focus, BNFT. Now, if you look at this chart on a daily scale, first thing you will immediately notice is that this is setting up for a technical breakout right through $15 resistance. Okay, so just draw a simple line. You can see that this is attacking that resistance for the last couple months, but multiple times it has failed. Yesterday was a very, very interesting bullish engulfing candle. Now let's see if it will break out through that. Here's another way of looking at this. You can see the RSI bull cross right here, the MACD bull cross right here. The volume has been surging for the past couple of days. The stock has been rising sharply, attacking this resistance and printing bullish engulfing candle yesterday. So let's see if this thing is going to start breaking out through that. This has about 9% short interest. So that's also going to potentially contribute to the upside. This is the daily scale. You can see that if you pull back this line all the way, this is a major VOP resistance level right at this 15 level. But if you go to the weekly scale, this is an absolutely disaster chart. Take a look at this. This is the last 3 years of weekly chart. I mean, this thing used to be a high-flying stock after it did the IPO, and then it just completely got obliterated in 2019 and 2020, coming down sharply. And this is where we're sitting right now. All right. And so at this particular point, this stock is trading at a very, very interesting multiple of approximately 1.6 enterprise value to sales. Very, very cheap. Now, why do I bring this up? If you look at this last earnings report, the company posted 11% revenue decline. Well, that's not good. That's awful, right? But the stock actually had a reasonably strong price action after that earnings report came out. Bad earnings, good price action is a qualitative factor that one should take into account when evaluating the opportunities in the market. Bad earnings, good price action. Has it bottomed? Looking at the long-term weekly scale, maybe it has. So considering that kind of price action, I went further to see whether there's something here that I should be aware of. Turned out this company has been signing a lot of deals to provide benefit management platforms, cloud-based benefit management platforms for employers, insurance carriers, and brokers all over the place. And the deal signing has actually picked up quite a bit. There is this first news that came out on July 16th of last year. Lincoln Financial is a very large insurance company, as you all know, and this company signed its employee benefit program, which is a cloud-based program to help companies provide analytics for the accident and critical illness and vision, dental, disability, life insurance, and all kinds of things for its employees and for its customers. This deal was signed on July 16th. A couple of weeks after that, on August 25th, they signed another big deal with Nautilus Reproductive Health Products and Resources. They also joined Benefit Focus, expanding their catalog service. After that, a couple of weeks after that, they signed this big deal with the University of Texas system. So all the universities in the state of Texas, they're now deploying Benefit Place. This is one of the largest employers in the state of Texas. They're employing Benefit Place. So why are they all doing this? I think there's a very simple reason for that. And the management told us that in the last earnings report. You see, this company actually announced about a year ago an AI-powered platform called Benefit Sage. And this Benefit Sage is their marketing tool, also a cloud-based optimization tool for taking care of employees and maintaining the cost systems for the benefits, for the employee benefits. This was launched about a year ago, but then the company immediately faced the pressure with capex cuts declining everywhere due to the pandemic. So it didn't take off right away. But starting from June to July months, this AI-powered platform called Benefit Sage is started to pick up. And as a result, we started to see growth rate actually re-emerge. Skipping through a lot of details here to keep it high level. And I think this is the reason why the stock has started to react positively with all these deal signings coming in. So if you look at it from a historical context, you're going to say, oh my gosh, on a weekly scale, this stock is a disaster. And, this company reported minus 11% revenue decline. But maybe this is about to turn, to an inflection point with a positive growth on a year-over-year basis with these deals coming and this major product now coming into the picture, which is called Benefit Sage. Regardless, keep up, put a trigger at the $15 per share. I think if this thing takes this out, you're going to see this thing run towards $20 per share over time. Earnings will be coming out sometime in the first week of March. That's it from me. Let's go to Jay.
Morning, everyone. So today, taking a look at Casey's General Stores, symbol CASY. For those that do not know, Casey's is a convenience store operator that has a presence in 16 different states, specifically in the Midwest. When you take a look at the breakdown of its stores, 56% of them, so more than half, are in towns with less than 5,000 people. I myself live in a small town, well aware of what Casey's is all about. Anyway, back on January 12th, the company provided a business update that was essentially in line with prior management commentary. They said inside total same-store sales were positive with low single-digit growth. And if you extract that, you had grocery same-store sales were up mid-single digits, but that was offset by prepared food and fountain same-store sales, which were down mid-single digits. And I'll get to future channel checks in a bit. The other update was on their recent acquisition of a company called Buchanan Energy, which owns Buc-ee's convenience stores. This happened back in early November. They acquired the company for $580 million. And the update here was that both companies received a request for additional information from the FTC. Ultimately, this just extended the anticipated closing date, which was expected to occur at the end of last year. So we are still waiting for that to happen. And once it does, the plan is for Casey's is to convert many of these convenience store locations under the Casey's name. Then last month, KeyBank met with management after the ICR conference. And some of the takeaways from that event were that management believes that the pizza business that it has, which has benefited from the pandemic, will see sustained strength. And, some people might hear that and think, they don't associate pizza with Casey's, but as I mentioned at the top, more than half of these stores are in small rural towns. And I myself, in order to go to, Starbucks or a McDonald's or a Walmart, I have to travel 25, 30 minutes. So you can see the convenience factor in just, going up the street and purchasing pizza or any other hot item that the company has. Also, the company has continued to roll out its private brands, which is going to lead to higher margins. It's early. It has only reached 3% of total mix, but that has already exceeded the target of 2% by year end. And then one interesting note that I found was that management remains optimistic in the long-term strength of its inside store sales, even if electric vehicles become more prominent, as 70% of the items that are purchased in store are purchased without fuel on an industry-wide basis, and Casey's believes it tracks above this trend. But to sort of offset this, the company is working with a company called Electrify America to bring electric vehicle charging stations to Casey's locations at a very low cost. Management expects 12 to 20 stores to add these charging stations initially. And then the final point was last week, BMO Capital was out with a note highlighting C-store data published by IRI. And that data showed that national convenience store sales increased 5.9% in the 4 weeks ended January 24th, which was ahead of December's 1.7 sales growth and the strongest 2-year stack in the last year. The primary driver of this increase was volumes, which increased 1.6% in January versus minus 2.7% in December. And then all major categories within this accelerated month over month, with beverages up 6.2% in January versus 0.4% in December. Tobacco, liquor also improved. Food was down 0.8%, but it was an improvement from the mid-single digit decline from the prior month. So overall, channel checks are strong. Everything seems to be going right. They're still waiting on this acquisition for Buchanan Energy to close, but overall, checks are strong, and we'll probably have to wait another couple months for the company to report earnings, as the last time they did was, I believe, in early December.
Very interesting update. I think the most exciting part of that discussion was when you mentioned that they're going to be installing these charging stations in all locations. I wonder how fast or quick that rollout will be.
It seems rather slow. I mean, like I said, they expect 12 to 20 initially, and the company operates obviously well more than that. I think 2,600 stores total for the company, so it's a small rollout right now.
Yeah, they definitely have a niche category to themselves, and they seem to face far less competition than, let's say, Kroger or somebody else, simply because of how they're strategically located in the rural areas, in the small towns, and basically with a bit of a monopoly, essentially, in each of the locations where they're present, and so that shields them with some with pressures and keeps them some pricing power. Gives them some pricing power. So interesting update. Chart has been rather pretty strong, making constantly higher highs and higher lows. A very steady, slow mover on a percentage basis. Relatively speaking, it's not a high beta name, as it's a grocery store or convenience store, I should say. Recently has been running strong with MACD and RSI bull cross. I think it's all a non-likelihood this thing is going to tag new 52-week high and go to 220 plus. All right, and so and I think this earnings report should be a good one based on the very channel checks that you just pointed out. So good one, interesting. All right, let's go to Chronicle.
Morning. I was just checking out Casey's mac and cheese pizza. I didn't know that was a thing.
Oh, it's a thing.
Mac and cheese pizza. So no setups today. Instead, I wanted to provide additional color on BigCommerce, ticker BIGC, which is a long position that some of our clients have currently since the start of the year. It's no secret that this is a heavily shorted stock at 20% short volume ratio. And I just wanted to use this morning to clear up some of the confusion. So the first common misunderstanding I'd like to address is that this weird belief that BigCommerce is in direct competition with Shopify. Not completely true, because the mistake here is that they're just simply lumping all e-commerce vendors together in the same category. Instead, if we look under the hood, what we'll notice is that BigCommerce operates mostly within the mid-market segment. So we're talking about customers and vendors that are making roughly 6 to 9 figures in annual sales, 7 to 9, sorry. Like, for example, we cannot seriously be asking Reebok or Avery Dennison or Ben & Jerry's, to use Shopify for their business, right? Because that would be like the equivalent of asking a hedge fund or a prop trading firm to use Robinhood. Maybe that's not a good analogy, but you get what I mean. Like, Shopify simply doesn't have the kind of management system and scale and flexibility that mid-sized businesses need, because Shopify is typically meant for smaller businesses and startups, as well as mom and pop proprietorships who decide to take their business online. That's what Shopify mainly caters to. So it's not exactly the same pie, even if there is some overlap. So let me give a couple examples of how BigCommerce is better than Shopify when it comes to mid-market. My first point is flexibility. Specifically, I think BigCommerce offers much more flexible inventory and warehouse management onboarding compared to Shopify, and that platform also allows for the addition of a lot more intricate options for the vendors' offerings. Like with Shopify, what you see on the platform is essentially what you get, because they actually restrict a lot of commonly used API calls and useful third-party software plugins. you can't really tweak this to your complete liking. So Shopify actually makes inventory and supply chain syncing very slow relative to BigCommerce for the mid-sized vendors, because in contrast, BigCommerce is flexible in terms of allowing vendors to customize and mess around with API calls and perform integration with other external functions. So BigCommerce has been built with bigger customers and larger catalogs in mind. So that's the first rebuttal I will make. The other point I have to make is to do with how BigCommerce and Shopify charge their customers. So with Shopify, the company makes a lot of its money off of credit card commission. And according to their terms and conditions, if their vendor wants to bypass Shopify's credit card gateway and use a competing one, in that case, Shopify will insist on taking a 2% cut. So obviously, the problem with this when it comes to the bigger companies out there with at least 7 figures annual revenue is that these commissions and fees can start to add up over time, whereas BigCommerce doesn't charge its customers this way. Instead, most of their charges comes from subscription and professional services and GMV-based contracts in some cases. So unlike Shopify, they're not making non-subscription revenue almost solely from taking commissions off of merchant transactions. So if you're not a small company, then BigCommerce's structure is obviously more attractive. Now, the last point I want to address is to do with how the bears have been pointing out that the company has negative margins and has been burning cash. What I will say is that there's a lack of nuance in this argument, because if we look at where BigCommerce is spending their money, a large chunk of it is actually going to R&D to build on their SaaS so that they can start to move upwards from catering to the mid-sized businesses to becoming a full-fledged enterprise solution, which is going to result in further growth down the road. So we shouldn't be too worried about the cash burn, especially given that they have $180 million of cash on their balance sheet with only $22 million of debt. So that's essentially the additional color I wanted to add to what was already in the original write-up, just to help address a lot of the misinformation that's out there. Basically, the main takeaway here is that BigCommerce and Shopify are not in complete direct competition, and this company should not be analyzed as such. I believe this entire e-commerce space is big enough for everybody. There doesn't have to just be one winner.
Great stuff, and thanks for that background and refresher, Chronicle D. Purely from a technical standpoint, this $90 remains a key wall of resistance for a long period of time. There was only one attempt, and it was rather on high volume when this stock was surging in late January, and we breached through that. But then the first attempt failed, and which is quite common. You see the first attempt fail, and then a modest pullback, and then correction, and then the second stronger attempt comes in. And I think we may be setting up for that here, for a clean breakout once again through $90 per share. This is also a cup and handle formation, so bullish structure here. Essentially 22% short interest should keep the bulls in play once this thing starts to play out, and it's one of those high momentum names that can add 20, 30, 40% in the stock rather very quickly, further squeezed by short squeezed as well. So I love the technical picture, and I love the pictures that we have presented previously today, as well as in the chat room, in the quarterly outlook, and other spots. So looking forward to this one eventually breaking out and running to 100 plus. I think that moment is coming pretty soon. All right, folks, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.